Hey everyone, John Henry here, Slingshot Futures Trading Group. Thanks for joining me in today's video. Before we start, take a second to give the video a like, subscribe to the channel, and make sure to click the notification bell icon so you don't miss our next live stream or next video launch here on YouTube every day. Make sure you start your day off the right way. Don't forget your free morning brief that's waiting for you at ssftg.com/brief. In the top left, you can click on morning brief to jump into that. That's where you'll find all of our major DP levels right up here at the top, as well as a quick technical overview for the major 6 markets that we look at: the NASDAQ, the S&P, you've got gold, crude oil, the euro, as well as Bitcoin. Maybe you're looking to get a full game plan for the day, week, or month. Check out the join button below. Level 1 subs get a brand new members only video every single morning going over the major 6 markets and a game plan for the day. In addition to that, once a week I launch a weekly brief, and of course once a month we have our monthly brief as well. Of course, all members gain access to our private Discord chat server, and if you really want to get into the nitty-gritty, check out the live analysis room for level 2 subs, where you can see my screens in real time during the New York Stock Exchange Open. You can ask questions and interact with the other members, as well as bounce ideas off myself and everyone else. It's a fantastic environment, and I would love to see you in there. All right, and now on to the really fun stuff, the topic for today. Learning from the past and using market repetition as information. This can be done via long-term monthly analysis, like if January closes bullish, the year typically closes bullish. But it can also be something that's very small detailed, like an average percent move on a measured move, or the previous swing high broke 13 ticks. This next one is probably going to break 13 ticks. Regardless of how we're using it, historical information, that's where we're going to get and how we're going to really find some of the massive clues in the market and what the market's going to be looking to do next. So one of my favorite ways to use historical market movement is to compare it to previous moves, obviously, but looking at things like previous swings, impulses, previous moves of a leg, that kind of stuff. This allows you to compare to the previous moves in a market of what was expected to happen and then what, actually happened. So as an example, if we look at the chart here, when we're catching a leg to the upside, initially before we see all the other stuff, we've got this nice move down. And if I see this coming into the morning, I'm expecting that we're probably going to keep going down. I have every reason to believe that sellers are going to take it lower. So we can utilize this information to try to drive a little bit more of an idea of what to expect. Let's bump this forward so I can actually see. There we go. So we can take a measured move potential from the top and follow it down to the next one. Now, obviously, this one just completely destroyed the move, but that still tells us something. We had this move from the top to the bottom, that distance. Now they broke down aggressively. A lot of times when you have this leg, they will form the really wide middle leg, and then this one will come back to haunt you down here with the same size. So when I have this kind of movement, measured leg, big blow off in the middle, utilizing historical information, I would expect the market to want to go down to around like 817, and it didn't. That doesn't mean that I all of a sudden failed in my analysis. You're not going to be right 100% of the time, okay? You got to get comfortable with that. But what this does tell us is that sellers were expecting one thing to happen, and it didn't. And that can give us a huge amount of information in terms of what to expect next, because this is a scenario where sellers are stuck. It's obvious that they're stuck, and they haven't made their objectives. Otherwise, well, they would have gone a little bit further down and hit some of those. So really what it comes down to is a market that's doing what is expected will move predictably. It's reliable because you can expect it to do that. It's not shocking anybody. And therefore, it typically doesn't go as far. Big moves happen on surprises. So then the next logical thing would be a market that is whipping all over the place and is very unpredictable. That's going to be much less reliable because the moves that happen, they're going to take traders off guard. They're not going to be sure when's the next whip going to happen. Am I going to get chopped out here? Maybe I shouldn't put my stop right there because I'm going to get taken out. It gets really, really wishy-washy.
So in this example, we have a missed measured move that will eventually, usually almost always, at some point, come to fruition. It didn't end up happening until way up here, where they finally got that pullback that was wide enough to achieve the objective, right? We got that measured move pullback, same size, bounces back up, job's done. But it happened way up here. Just because it blew away from it doesn't mean that it's invalid and all of a sudden you have to start not paying attention to it. That's the best part of it, is that once you understand what the market situation is and in what situation you are in currently, they both become reliable to a degree, right? You have the unreliable, unpredictable, whippy one, and then you have the reliable. But if you understand what's going on, they can both be reliable to a degree. Nothing's ever 100%. But as we can utilize previous market movement as a future guide, we can assume with a pretty good probability, at least, what the outcome of any given type of scenario is going to be. Now, generally speaking, markets don't like transitioning from one extreme to the next. That's not really their forte. They typically like being able to slowly and gradually shift, going from a big move up to a range, then a reversal, not just a V top, although that does happen sometimes. So if a market is trending, it's going to want to keep trending more than, at least more often than not. And that means that if I suspect that the market is reversing, a lot of traders love catching those reversals, right? They try catching those reversals all the time, and it usually ends up cutting them. But if I suspect the market's reversing, if we understand this context, then it would still be higher probability for me to take the trade that is a continuation rather than the reversal, because markets don't like to just straight out reverse. So to gauge the best probability, then I have to look back at what the market's done previously or historically when there was a successful breakout or when there was a successful pullback hold or whatever I'm looking to repeat. How it moved, what it did when it did that move, where it went, etc. All of those things are big important factors in how to kind of gauge what's going to happen next. And remember, it doesn't just have to be on one scale looking super, super close. It can be on an aerial view where you're zoomed really far out. In fact, if anything, this is where I prefer to use it because I'm looking to utilize this more as a market objective. Where's the market generally wanting to go? Right? Well, if this is breaking to a new high and I'm, over here, I don't know where it's going to go, but I know that if they do want to try to go higher, maybe they gun for that measured move and it puts it right back at 13,000. See how we're already stacking things together? Immediately, right out of the gates. So my upside objective starts pinpointing towards 13,000. As long as we're not hitting that area, then I have a reason to believe that the market's going to want to keep going up and up and up until it finally decides to do something. In this case, it dipped further. That doesn't mean that the measured move is, all of a sudden we got to recalculate everything. It just means that it's a little bit lower. And now they're hunting for this objective. And you can see, once they met that objective, look at the amount of resistance that took place. It got stuck there forever before it finally decided to break through. And even then, it was like the rest of the day it was stuck there. That's why I like keeping an eye on these zones and using this historical information to give us an idea of what's going on. And more importantly, if it's following through with what it's supposed to be doing or not following through with what it's supposed to be doing, all of that information is incredibly useful in trying to figure out what it's going to do next. All right, but that's going to do it. So going over just learning from the past and using market repetition, using things that have happened previously and expecting them to happen again is kind of what trading's all about. And when it doesn't do what you expect it to do, that doesn't mean that the trade's all of a sudden garbage. What it means is you have more information that you can digest, and that potentially gives you a new setup in the other direction. So learn from the past. It's important information and it's there. Everybody has it to their advantage. You just got to look at it. So don't lose sight of it. But that's going to do it for this one. As always, if you have any questions, shoot me an email, jhb@ssftg.com. Until the next one, enjoy the rest of the day. Like we always say, keep those stops in play. Stay safe out there and let the winners run. Until the next one, enjoy, rest up, and we will see you all then. Thanks.